in Kongstedt, and I'm also known as CPH Equities on eToro, and this is my Q1 2025 status update for the first quarter of 2025. And it has been a while since I made this update the last time. Usually I do it every quarter, but I've been a bit delayed due to Easter vacation, but now I'm back. And today we're going to speak about my performance for the last quarter, the portfolio as it is now, how 2025 has gone so far, and also what I've been changing recently, and then obviously about the whole situation and Trump's policies and how I see this going into the rest of 2025. And I'm not going to do much of a presentation of myself today, because I will put a link to the video, which is on YouTube, that gives a short presentation of me. So if you don't know me, then you can take a look at this video and get an impression on who I am and how I view the markets. I've been doing investing on eToro for 8 years now. And you can see my performance here. I've been having returns of around 18% on average each year. Most of the years have been double-digit returns, except for one of the full years. And obviously this year, as we're going to speak about, has been a bit of a rough start, but the market is slowly inching back at this point. So overall, I've had this return of 18%, which is almost twice as much as the general market. So as you can see here, my returns are almost 245%, while the market measured by the S&P has returned 128% in the same period. So if you look at this graph down here, you will see my returns with the green one and the returns of the S&P with the blue one. My plan with being on eToro is to take my account to $1 million. And I've been doing this for a few years right now. I've calculated this is going to take me 13 and a half years to get to this target. And currently I'm at 100,000 and $13,000. And I'm a bit behind my target at this point due to the latest correction. I was actually on target half a year ago, but now I'm slightly behind my target, but I'm still keeping the target, and I think it's certainly something that is achievable. The portfolio right now is the same structure as it usually is. I have the core of the portfolio, which is tech and AI. I have 36.2%, which is in these stocks, and those are some of the companies that I think are defining our world today, which are the tech companies, the AI companies, semiconductor companies, which I think that if we look like 3 to 5 years into the future, those companies are certainly going to be defining for how this future unfolds. And I want to look a bit ahead when I set my portfolio, when I build a portfolio, because I think you shouldn't be looking at only where we are at present, but also where we're going to be in like 2 or 3 or 4 years. So that's the way I've been setting up this portfolio. And you will see companies like Meta, Microsoft, Google, Amazon, TSMC, Nvidia being the main companies in the portfolio. But also recently I've been adding gold. No, that's actually not recently. I've been building up this position over the last few years. But recently gold has become one of my absolute top position during actually most of this year. And gold has also been one of the best performing assets of all assets, returning more than 30% this year. So I'm happy that I actually made this decision to have gold as a hedge in the portfolio. It has been number 1 or 2 position in the portfolio for most of this year. And you can see that while my portfolio is focused on tech, I also have a lot of exposure to other sectors like finance, consumer defensive. I also have hedges like gold, uranium, and Bitcoin, which I also see as kind of a hedge, and which actually have been performing quite well compared to the overall market, the stock market this year. Looking at the portfolio, I have this core of AI and tech, which is the green part of the portfolio in this diagram. And then I have a part of the portfolio. I kind of try to build more portfolios, like 3 portfolios in one portfolio, which makes it possible to have good returns in many different scenarios at many different times. And this makes it possible to diversify more my portfolio in a way so we don't get huge drawdowns during single days or single months or single years. So I try to have a divided portfolio, which is divided into parts. And the main part is the AI core portfolio. The second part is a part which is more value oriented. But I have shifted my methodology for picking value stocks slightly this year. So I try to find value stocks that also have momentum. So it's kind of value stock that have a growth potential or also have a good price action in the market. And those stocks have shown in backtests to perform clearly better than the overall market. And then I have a part of the portfolio which I consider as hedges, which are assets that perform well at different times than the other parts of the portfolio. And those are the assets like gold, uranium, Bitcoin that I mentioned. And especially you will see the effect of these hedges this year, which is that especially gold has been performing very well when tech stocks and AI stocks have been performing less well, and the overall stock market has been performing less well. Then we see hedges like gold performing pretty well and also Bitcoin performing decently compared to the US stock market. So this is the division I made. So what changes have I been making during this turbulent period? So I've been changing my value investing methodology, as I just mentioned, and also I've been putting more money into hedges like gold and gold-related stocks. So the whole gold-related part of the portfolio is slightly larger at this point, and it's almost 10% of the portfolio. I've been adding some defensive stocks that can do relatively well in a more stagnant economy. So this means that even with those scenarios that we have been fearing this year, that a recession might be coming later this year, at least in the US, is something that I've tried to hedge against in this way with some success. And I've also been exchanging a few US stocks with European stocks to get more European exposure, as I thought this would be appropriate this year. Especially the European defense stocks have been performing very well, and those are part of my portfolio as well, and also have been a good diversifier in the portfolio. So the general idea about my portfolio is to try to have the good tech exposure, but also mitigate those bad periods that we see tech having now and then by having other parts of the portfolio that performs well during these periods. And especially gold and the European defense stocks have been performing quite well when tech stocks have been performing less well. The current markets, right now we're seeing a turnaround in the S&P 500. So we had this correction of almost 20%, and almost driving the S&P 500 into a bear market. And now we're seeing a turnaround. And this is obviously related to the events with regards to what Trump has been trying to impose on other countries, the tariff he has been announcing, and also the way he have dialed those tariffs back afterwards. And that has been the main driver in the markets. And I'm going to get back to how I see this going forward. But it has been a quite interesting and very volatile period of the markets. Obviously, returns haven't been great, but my portfolio is performing slightly better than the S&P 500 at this point, which is overall a good situation. So I think at this point, My portfolio is around minus 5.5 in the negative, and the S&P is minus 6.5. So it's doing slightly better due to the hedges I put in place earlier this year. And looking at Bitcoin, Bitcoin is actually doing quite well during this crisis. It's usually more volatile than the market, and when the market falls, it usually falls much more. And this year it has been a much better situation. Bitcoin has been a much better hedge, even though it's still quite correlated to the market. It hasn't been hit as hard, especially during the latest downturn. So that's quite promising for Bitcoin, and I think that it turns out that if it can be used as a hedge to some degree, then I think that more hedge funds and more fund managers will pile into it. So generally, it's a pretty good sign for Bitcoin at this point, and also it's rising again. So I think that's quite promising. Then gold, obviously the winner this year, and also one of the main positions in my portfolio. It's up 32%. Certainly something that I'll keep staying invested in. Right now, it's a bit overbought, but that's only going to last for a moment. We're seeing a small correction, and then my best guess is that there's still a lot of demand in the markets for gold, and we're seeing central banks buying gold. We're seeing hedge funds have been buying, and the demand is just very, very strong, and I don't see it going away anytime soon. It seems like especially like China is taking out money from US investments, putting them into gold. And then obviously those are huge amounts that are going to be redirected. So I think it seems like gold, the fact that it has been such a good hedge this year also means that a lot of people are going to use it as a hedge going forward, because bonds have not been a very strong hedge. The US dollar hasn't been a strong hedge. So in this sense, you need other assets to hedge, and gold has certainly been the best hedge this year. So I think that people is going to keep it and use it as a hedge in their portfolio. So that's quite promising as well for the demand for gold. And actually, over the last 20 years now, gold is performing better than the S&P 500, which is quite usual. Usually, gold has been viewed as an investment that you would have maybe more short term to protect against inflation or uncertainty in the markets. But now it also turns out that it has been quite a good investment just by itself. And that's also a very promising sign for gold. US recession risks have been rising since March. It was more than 60% in this poly market poll, where you can bet on the chances of recession. Right now it's a 53% chance. So obviously these risks have risen quite a lot, and it is a risk that we have to take seriously, especially due to the tariff. If those stay in place, it's likely that the US could go into a recession this year. Most likely, if it happens, it wouldn't be a deep recession. So I still think that the risk to the downside, based on the information we have right now, is still quite limited. But obviously, the erratic nature of the US government policies makes it difficult to predict for a very long time what's going to happen, because if new initiatives are taken all the time, then obviously something can change very quickly, and the markets can turn around. But at this point, there are no signs of a big recession coming. The only thing is that if the tariffs stay in place, then obviously you increase the chances for this to happen. So Trump's policies have been the big discussion point this year, and the 10-year Treasury is actually the key to follow in this market. So what happened is that 1 month ago, Trump he imposed or announced a lot of new tariffs on countries all over the world, and this is obviously old news at this point. But what happened was that the stock market dropped a lot and we had this almost 20% correction. But what was more important was that the 10-year Treasury bond yield rose sharply. So this means that a lot of bonds were sold. So when the price of the bond falls, then the yield rises, and we saw the yield rising very fast from around 4.0 to 4.5 in just a few days. And that was actually a really scary moment for the US government and also for investors because it showed that something was quite out of the ordinary. There was something unusual going on, and people were selling the treasury bonds to a very high degree. And actually, this made Donald Trump paddle back. So it was not the correction in the stock market that made him dial back a lot of the tariffs, but mainly the fact that the treasury yield rose so much in such a short period. And the reason why this is important is obviously because that if you have to refinance your debt, and that's what the US have to do this year. They have to refinance 7 to 8 trillion US dollars this year at a new interest rate. And obviously, if this is going to be on an interest rate that's closer to 5 rather than 4, then there are going to be a lot of interest payments, and that hurts the US budget. So Trump, he was kind of forced to dial back the tariffs to a large degree, and I think he got. I mean, he didn't look afraid, but it was actually a scary moment for him, and I think it's going to make him more cautious in the future because he knows that this is actually a real threat to the U.S. economy, and if China or other large countries start selling their treasury notes, then it's going to be a serious issue for the US. So it seems like Trump had the best cards on the hands. That's the impression that he had himself. But actually, China may be having much better cards on their hands. In many cases, the first thing is that they could actually start selling to a large degree the treasury notes. They're not really interested in doing that. But if they start doing that, and maybe they already did, that could put a huge pressure on US interest rates. And that's a problem for Donald Trump. Also, China has a lot of other strong cards on their hands. They can limit the imports of rare earth minerals, which is a huge deal for the US to produce weapons and smartphones and so on. And that's actually a very strong card that China has on their hands. And then the third thing is that China is a country that's not a democracy. The US is. So this means that every time that people are disliking the policies of the current administration, then they're going to be protesting and arguing that this is not right. For instance, when Trump he put tariffs on components to smartphones, if this is going to rise the price of smartphones by a margin of like 50% or 70%, it's going to be a huge deal for US consumers. In China, it wouldn't be that big of a deal because it's much more difficult to protest in China. It's not a democracy, so they can take much more pain. So while the Chinese may not like a trade war or tariff war, they are in a better situation to handle the uncertainty and also the uneasy feeling in the population about what consequences this may have. If there's recession in China, it's easier for them to handle than a recession would be in the US because everyone would be looking at Trump in this situation and asking him why he imposed those tariffs, which led to a recession. So for this reason, Trump has been dialing back some of those tariffs. He maintains a 10% base tariff on most countries, and a 25% tariff on steel, aluminum, and car-related goods. And those tariffs are most likely to be staying in place. But a lot of other tariffs are likely to be dialed back sooner or later, in my opinion. So we've been seeing other countries responding to the tariff. Canada has been imposing a 25% tariff on American food and electronics. China is also responding, of course, very strongly. And the European Union is considering tariff on various American products, but still they are kind of slow to get the response announced. So at this point, we don't know exactly what they are going to do. Also, Trump had a big fight, or mainly he was fighting with Powell, the Fed chairman. Powell was not really fighting so much with him, but he started a few days ago. He called him a major loser. Trump called Powell a major loser and demanded that the interest rates were cut immediately. And Powell has just been responding and warning about that the tariff could lead to stagflation. And Trump was like, it seemed like he was investigating the possibility of if it would be possible to fire Jerome Powell. But now Trump denies that he will fire Powell. And Powell is most likely going to be in office until the summer of 2026. But the markets don't like this uncertainty. Like when Trump started to threaten Powell, the markets fell once again. And I think that Trump is starting to recognize that some of the initiatives that he's taking is certainly not to the liking of the financial markets. So my guess would be that he's going to be more cautious in the future, and also that he's going to dial back some of the initiatives that he has proposed. So the tariff that he announced 1 month ago is most likely going to be a negotiating tactic, in my opinion. Some tariffs are going to be in place, like the steel, aluminum in place. Tariffs are still going to be in place. But Trump will ultimately avoid aggressive tariffs that visibly impact consumers, in my opinion. For instance, the tariffs on smartphones and on certain medicines, because it's going to hurt the consumers too much. So for this reason, I think that he's going to probably be a bit more cautious about some of these things in the future, because he's not going to challenge the markets too much. But it's going to be volatile. There's going to be new uncertainty, and for this reason, we are in no way going to be having a smooth sailing as investors during the next year, probably year or two. It's going to be challenging as investors. That's for sure. It's not necessarily that the markets are going down. I don't think they are, but it's going to be volatile for sure. So, a bit about the macro economy. The inflation has still not hit a target. Core PCE, which is what the Fed mostly looks at, is at 2.8%. They would like it to be around 2%. So we have not yet hit the target. We're seeing that the market expects 4 interest cuts in the US at this point. And right now, the sentiment between investors is at extreme fear levels, which means that the whole situation about the tariffs has made everyone sell out. And at these levels, people are just very nervous about what is going to happen. I've been arguing that this correction has been an event-driven correction. I wrote an update about this. And the thing about those kind of corrections is that you have huge drawdowns. You have very red days, but if it's event-driven, if it's not like fundamentally driven, like if it's not like a real recession coming, and that may be possible later this year, but if it's mainly an event which was driven by the announcement of tariffs and so on, then these announcements can be changed again, and they have already been. and then you can see some very large green days following the very large red days that we have been seeing. So that's actually what has been playing out. We saw huge correction in the market. We saw red days with like 4%, 3 to 4% red negative days in the S&P, and then a few weeks after we saw this turnaround, and we had some very positive days in the S&P. So the thing is that as an investor, you need to keep your head cool, because when you have those very red days, you often see that in the vicinity of those red days, you will often have a strong turnaround. You will have some of the best days of the years following those red days immediately after. So the last time Trump was in office, we had a pretty smooth sailing the first year, but as soon as he started the escalation of the trade war, we saw a correction of around 10%, and later we saw a 20% correction like we're seeing now. So every time we had these announcements, we saw huge uncertainty, and the main point of this slide is actually to show, yes, the volatility was much higher, but still the trend was going upwards during this period, even though it's maybe difficult to see when you're in the middle of it, but it was generally going upwards. So the trend was up, but it was with a much higher volatility than usual. And I expect still that this would be my base case, that this is the scenario we're looking into. I still expect the market to perform well over a longer period, but with huge volatility during times. And actually, I think that you should still be seeing those dips as buying opportunities like it was this time. If you have money to spare, or if you are putting extra money to work, then you could be doing it during those dips. And that's actually the most difficult thing to do, because when you have those dips in the markets, as we've been having now, you have the highest uncertainty, you have people speaking about recession, and that's actually the most difficult time to buy. So another strategy is just to try to invest continuously, and that's what I would advocate if you don't want to try to time the market, as this is really, really difficult. So we've been seeing like volatility spiking as soon as we had those announcements the last time, and that's actually the same picture we're seeing this time. This is a picture of the VIX, which shows the volatility, and the volatility just jumped a lot when he started speaking about the tariffs the last time, and that's the same situation now. But over time, the market has been going or was going up during the last period when he was president. So during those uncertain periods where you have the very high volatility and you have the VIX spiking, that's actually usually the best moment to buy. So when the VIX spikes and goes beyond 27, usually you have had quite good buying opportunities at these points. So that's actually the same that has been happening this time. So all of this is obviously based on the information we have now. If the facts change, I can change my opinion. But the way it looks now is still a picture where I believe that the companies that I've been investing in are very strong companies. Even if they're in the US, I believe they have a very promising future. And you can go through my portfolio on eToro to see what companies they are and how they're doing. So I think that's something you could look into. Then I want to say something about the market in general. Like, the start of this year has been the worst start, the third worst start ever in a stock year. If we look 100 years back, we only had 2 years that were worse than this, which were in the 1930s. So the first 75 days we had a negative 12.3%, minus 12.3%. And that's the third worst start to a year for the last 100 years. What we see often in those years is that the market has been taking some of this back. So in the other top 5 worst years, we saw double-digit returns for the rest of the year. I'm not saying that this is going to happen this time. I'm just saying that if you look at the history and you look at it statistically, Then these years where the year started pretty bad, we quite often have seen situation where we had a comeback later this year. Obviously, there are a lot of exceptions to this. 1941 during Second World War is one exception. The financial crisis in 2008 was another exception. So there are exceptions to this. Obviously, if there's some systemic problem in the market or in general in our societies. But in general, we've been seeing, at least historically, that the market has made a comeback. So it's certainly possible that it could happen this year too. It's at least something to look out for in a situation where everyone is very scared about the future. And sometimes you need to keep your head cool and look a bit at the statistics and say it's certainly possible that this market could turn around for the better. We have to keep this in mind that it's a possibility. But I don't want to make any clear prediction about what's going to happen, as the US government policies are quite erratic. Anything can really happen based on the way they act. This makes it fundamentally very unpredictable. So in this sense, I will just point to the fact that it's statistically possible that we could have a decent turnaround. And we are already seeing a decent turnaround right now. But for sure, uncertainty and volatility is going to remain. So that's actually my most likely scenario, is that we will see still uncertainty, volatility. I think that Trump and the rest of the US government will be more inclined to announce positive news in the coming period about deals being made with different countries. They will try to settle negotiations, and they will try to portray this as a victory. Perhaps they get Europe to buy more like liquid natural gas. Perhaps they get other countries to buy other things from the US, and they're going to portray this as a victory. And based on this, you could see markets rising. Obviously, there are a lot of risks in the market. One risk is the stagflation risk that I mentioned. Another thing is that I believe that the US-China trade war will remain unresolved for some time, as it seems like China is not going to back down, and they're not going to be an easy negotiation partner. So I actually expect the US-Chinese negotiations. They haven't even probably really started yet. I believe it's going to be unresolved for some time, and that's going to add uncertainty to the markets, and the markets certainly don't like uncertainty. So that's something to watch out for too. So the risks are, we can have an escalation of the trade war. We can have higher risk of both recession and inflation, and a stagflationary environment, which is the combination of the two. Then we can have geopolitical risks, and also the US enormous national debt is certainly something that's always a risk and worth looking out for. So I want to end this webinar or this video by quoting Warren Buffett, obviously one of the best investors ever, which is he said something interesting about corrections. Now we've just been seeing a 20% corrections, and I've been trying to argue about this to make this argument as well. We had a 20% corrections, and I see a lot of people being worried, and I also see a lot of people closing their positions, and obviously for different reasons. There can be many good reasons to close your positions, like if you need the money or so. But if you close your positions because you're scared, because there's a correction, then it's probably not the right motivation to do it. So the quote from Warren Buffett is that if you worry about corrections, you shouldn't own stocks. If you can't take your stock going down, it's going to go down sometime if you own it. So why would you worry about that? And then he says, you shouldn't look at it day to day. If you bought a farm or an apartment house, you wouldn't be getting a quote on it every day, every week, and every month. So it's a terrible mistake to think of stocks as something that bob up and down, and you should pay attention to all those bob ups and down. So I think what he's trying to say here, and the point I've been making too, is like if you get confused by the volatility, if you get confused by the corrections, then you should consider if stock investing is something for you, because those corrections are going to be there. We're going to see corrections in the future. We see a 5% correction every year almost. We see a 10% correction every second year, and so on. And it's very scary. And I understand it if you're a new investor, it can be very scary, but it's just very important to keep your head cool, because if you sell out when there's a 20% correction, you're usually selling at the completely wrong moment, and it's just something to look out for. So keep your head cool and stay invested for the long term. So I want to end this by saying the best way to do is, in my opinion, is to make investing a habit. Take a little bit out of your paycheck every month or every quarter, every half year, and invest it in some way. I think the best way to invest it is in stocks. You can copy me, you can buy single stocks, you can buy an index, just invest every month, and you'll be happy that you did this down the line, because it's going to be the easiest money you're going to make. It's going to take a long time, and it's going to have a lot of ups and downs, and it's going to be difficult to keep your head cool. But if you can do it, you really did something very well for your future self. And then thank you very much for this time. If you have any questions, you're welcome to ask them in the comment field on YouTube or on eToro, where I will always be able to get back to you quickly and answer your questions. So thank you very much. See you next time.